And so now you've got unit account, store of value, medium of exchange built on digital capital. The way I see the industry evolving is there's 3 layers. There's digital capital, there's digital credit, and there's digital money.
Yeah.
Okay. Our company strategy, we exist to create the digital credit. In essence, the whole mission of the company is to convert capital into credit. I think it's reasonable for us to strip 80 to 90% of the risk and 80 to 90% of the volatility off of the capital, right? You know, if you're being very simplistic, right? I mean, I start with $10 of Bitcoin, I issue $1 of credit, right? So we can step it down from, you know, a 50 vol, 50 ARR asset and turn it into a 10 vol, 10 ARR, right? A 10% dividend yield. We can't create digital capital, right? I mean, that's the world, right? You need 700 million people in the crypto industry, and you need all of the decentralized holders and the people we don't know and the people we know and all the buyers. And it goes without saying, you know, it's an asset without an issuer. We're the beneficiary. It's very clear to me, right? I can buy $1 billion a week for the past 2 weeks. The price isn't paying attention to what I'm doing, right? And that's good. That's a good thing, right? It wouldn't be a stable digital capital network if anybody could influence it, right? And so the digital capital layer is a global phenomenon that's been running since Satoshi, you know, dropped the white paper, and it will keep running, and there will always be actors entering the space. The CFTC, the SEC, the BlackRocks, the Vanguards, the JP Morgans. I mean, they're all players in this space, the foreigners, the people you don't know. You know, didn't we just hear the Chinese shut down a bunch of Bitcoin miners?
Saw that yet again.
They banned Bitcoin mining for what, the 6th time in 12 years? It's like, seems like every 2 years or 3 years they like shut it down, but it just doesn't go away now, does it? So digital capital is a global phenomenon. We are beneficiaries, and we acknowledge that. And we build our company on that. Our job is converted to digital credit. And I think that's the one thing we can do well. And if you want to create digital credit, you need to be monomaniacally focused on digital capital. And, you know, for every $10 of Bitcoin I hold on my balance sheet, I can probably create $1 of credit. You know, you might even say, if you're being concerned, per year, by the way, you might say for every $10 of equity capital, I can probably create $1 of credit per year, right? And I can do that responsibly. And so over time, you know, Bitcoin's growing. We're layering on more credit. We're feeding the digital capital ecosystem. We're building our balance sheet, et cetera. But now that third step, creating digital money, you need the crypto entrepreneurs. You need the crypto exchanges. Maybe you need the Binances. You need the Coinbases. You need... Yeah, maybe you need the proof of stake chains. Maybe you need the crypto. You know, how many different entrepreneurs have created a stable coin? Yeah. Right? You need them. You need fund managers, right? You need the private fund managers, the Bloomberg jockeys. Like, I got hit with, you know, $150 million of redemption today. I'm going to sell down the currency equivalents. All of a sudden, I'm 95% credit, 5% currency. Now I have to rebalance back to 80% credit, 20% currency. I'm trading, I'm managing, I'm hedging. And so you need the fund managers. Then you need, you know, you need the fund managers, either private or public managers, to actually create the digital money fund. Then you need the, you know, a crypto entrepreneur to create a crypto coin. You need a public ETF manager to take your fund public. Right? A pretty big idea is I take private funds public. We forget, but the original tokenized fund was an ETF. That's right. Right? I mean, and believe it or not, the world's still full of a lot of asset classes that yet to be put on an ETF. You know, go try to buy an ETF that reflects a bunch of old masters' paintings. Yeah. Can't do it.
Right.
Try to buy an ETF that reflects New York City real estate and passes you through a dividend which reflects the rents. I
don't know of one.
Yeah, but the point is there's a lot of financialization to be done on traditional ETF rails.
So we shouldn't be surprised that we're not there yet on Bitcoin rails. That's the 10 years, 20 years we're talking about.
Yeah, BlackRock's done, 1,000 ETFs, but they still haven't done, the 10 that I want.
Right.
Right. And then, of course, you need the banks. Right. What's the value added of a bank? Well, okay, the bank first they got 10,000 salespeople. Then they have a brand. Then they get the banking regulator to approve it. Then you've got the platform, right? All sorts of platforms. Then you've got the account. You strip the vol. And then you dispense daily doses of dividends. You deal with the tax compliance, the legal compliance, the KYC compliance. Some dude wants to buy $10 billion of digital money in there, believe it or not, if you're the first bank to offer digital money in the Middle East and some guy wants to wire you $10 billion to buy it, you still have the AML, KYC, the compliance issue, and you got to jump through hoops to do it. So the way I see the industry evolving is the first layer is completely decentralized. The second layer, digital credit, is going to be created by companies like Strategy or MetaPlanet or Strive, right? A treasury company that's monomaniacally focused on creating digital credit instruments. And then the third layer is really up for grabs. There's 1,000 banks that could do it. There's 1,000 fund managers that can do it. There's 1,000 crypto investors or entrepreneurs that can do it. And the truth is they are all adding value, right? Whether it's technical, right? Do you have the technique to put it on the platform? Everybody's got a platform. We'll debate what's the right platform, right? There's going to be a big debate. Is it a crypto exchange? Is it a proof of stake network? Is it Aladdin that BlackRock runs?
Right.
Is it the in-house JP Morgan or Morgan Stanley or Goldman Sachs network? Is it a regulated digital exchange? There's, Europe has got one currency, 27 sets of regulators, 27 different exchanges and 27 capital markets. And you're thinking you want to distribute there, right? So I think that the exciting thing for us is what we realized is our mission is create the digital credit, but we have an incredibly compelling partnership opportunity or a partnership proposal. If you're the most digital forward bank in Australia, you want to create digital money in Australia, I have a deal for you.
Interesting.
Right? If you're the most ambitious bank in the Middle East and you want to create digital money, well, the first bank that does it is going to attract $1 trillion of capital. Do you want to be that bank? Do you want to be that city-state? Right?
Yeah.
Some people, some city-states will miss it. You've got nations that are more concerned about losing control. They would rather shut down the technology because they're afraid it might be too useful. Right?
Yeah.
So you have some that won't move. You have some that don't even get it, right? They don't even notice it's happening. What is the digital asset thing anyway? What is this good for? And they're like digital beanie babies, right? And then you have some people that get it. It's like, oh, money moving at the speed of light, economic immortality, and maybe we can program it to think 1 billion times a second. Right. And I think that the ones that get it, now it's going to be a competition. There's going to be a question of who wins. And it's a team sport. You need the bank. You need the bank regulator. You need the fund manager. You need the partnerships. Right. And then you need to coordinate, all of those. And then there's a technical component. And there's a question of, are you willing to take a risk and can you market it? And, the likelihood that most people will be followers, but there's always going to be a leader, or a couple of leaders. And this is a battle for the future of money. And we're talking about, easily $200 trillion up for grabs there, but it's going to be $400 trillion in 10 years. And whoever actually creates digital money is going to grab 10, 20% of it for sure. You won't convince everybody, there's going to be a world of people who are going to think, well, I just don't trust that. That's too good to be true. But, roll the clock back. When people talked about Bitcoin, they're like, yeah, well, it won't work. Oh, well, if it works, it's too good to be true and the government will take away from you.
I mean, eventually the horse-drawn carriage pilot still buys a car one day.
But imagine a world where 10% of that money flows into digital funds and digital banks and digital bank accounts. And that's a profoundly disruptive world. And we will create the Switzerland of the 21st century. It'll be the world banking capital. And I'm hopeful it's in the U.S. I think, I don't know why it wouldn't be in the U.S., but if it's not in the U.S., I wouldn't be surprised if it doesn't pop up in the Middle East, because if you appreciate technology and you understand digital assets and you appreciate banking and you like money, the most profound idea I have for you, it's, why don't you just attract all of the capital in the world into your bank, into your state? Because Lord knows right now, the traditional 20th century banking establishment has a proposal, which is, give us your money and we'll give you nothing.
Yeah.
We're going to offer you return-free risk for all of your assets. You're taking duration and credit risk that does not offset, with yield that does not offset the duration risk and the credit risk. So pretty much you have hundreds of trillions of dollars, which is returning, inflation adjusted nothing.
I want to ask you a question, Michael. You said that your strategy is monomaniacally focused on this digital credit creation. Is that a reason why you wouldn't maybe use some of your Bitcoin to buy a Bitcoin business that could generate more Bitcoin? Is it not pristine enough to be the credit issuer if you also have other operating businesses inside strategy? Put
simply, we expect Bitcoin to appreciate 30% a year for the next 20 years. That is our risk-free rate. Like, that is literally the hurdle rate. I can acquire Bitcoin at 1 times revenue. It's a monopoly on digital capital. I can acquire the world's reserve capital network at 1 times revenue, growing 30% a year for the next 20 years, risk-free, integration-free, overnight, no questions asked. What could be better than that, right? Nothing could be better than that for us, right? Once you've actually established, yourself on the Bitcoin standard, and once you've rotated your shareholder base, right? The important point is not that everybody agrees with me. The important point is that all my equity investors agree with me. Mm-hmm. You see, our company exists to acquire Bitcoin. So if you bought me another option, you said, well, Mike, I've got this great startup and it's going to grow 40% a year for the next 20 years and emerge as a monopoly in the world. And I'm like, okay, that's great, Alex, but it doesn't sound as good as the deal I already have going. Like, what are the odds that you just found the next monopoly on money in the world growing 40% a year for the next 20 years? And by the way, let's say that you're a genius and you found it. What are the odds I can convince all my equity shareholders that it's better than Bitcoin?
Unlikely.
Yeah. And why would you, and by the way, why would you want to? Right? I mean, if you already have a risk-free rate of 30%, if you can buy it at 1 times revenue, and if you can integrate it overnight, why would you do anything else? So I think, for example, let's say there's 100 companies out there that are trading at a discount to NAV.
Yeah.
Okay, well, the world's full of private equity funds that have a mandate to invest in 20 non-correlated investments, and their hurdle rate is 10 or 15%. And they're actually suited up to deal with all the social issues and the headaches, right? They sit on boards, they hire and fire entrepreneurs, they integrate people, they lay off people, they fight with lawsuits, right? So it makes perfect sense for a private equity fund or a public company with a roll-up strategy to buy a bunch of businesses. If you believe in diversification, right? We don't, right?
Right.
We don't believe in,
You said, what was that great quote you had? What do you have, one screen? You only have one screen? You have one chair.
I got one chair.
You're sitting on one chair right now.
I got one
you don't
chair.
Have 2 chairs.
I don't believe in diversifying the fuel source that flows into your jet engine.
Yeah.
I believe in kerosene.
Yep.
I don't believe in diversifying the metals that make up the airplane wing. I believe in aluminum. I don't believe in diversifying, the composition of your semiconductor chip,
Right.
It's like you ever seen an NVIDIA data center? How diversified is the chipset in the NVIDIA data center?
Yeah.
Right? And I actually believe that when you find the solution, then you pursue it.